Many disastrous calls have been made by Wall Street's so-called experts, and today we will expose the real dangers behind trusting their half-baked predictions. Today, we're putting the spotlight on 3 analysts who completely fumbled the ball on Li Auto, LI, a company that looked poised to revolutionize the EV space until things took a shocking turn. What went wrong? How did these analysts miss the massive red flags waving in front of their faces? It's almost as if they had blinders on, and their clients left holding the bag as the stock took a nosedive. We're not just talking about a little over-optimism here, we're talking about analysts who should have known better. The numbers were there, the warning signs were flashing in neon. But these 3 analysts, blinded by hype or perhaps fear of going against the herd, stuck to their bullish calls, leading investors straight into a financial sinkhole. Were they too cozy with the company? Were they just plain lazy? Whatever the reason, their incompetence left portfolios bleeding. And today, we're holding them accountable. But there's more to this story than just misplaced trust in analysts. Li Auto's downfall holds crucial lessons for all of us. How could a company that seemed unstoppable falter so dramatically? And more importantly, how can you avoid getting trapped in the same kind of hype machine that led so many investors astray? Today's deep dive will uncover exactly where it all went wrong, and by the end, you'll walk away with the tools to protect your investments from the incompetence of others. Stick with us. This is one breakdown you can't afford to miss. As we explore the ups and downs of investing and the importance of making informed decisions, it's clear that adapting to the rapidly changing landscape is essential, not just in finance, but in content creation as well. And really fast, if you've been looking for a way to elevate your YouTube game, check out Matt Parr's Tube Magic course. This course is designed to show you how to leverage AI to create a successful YouTube channel. In today's digital world, AI is cutting-edge technology, and those who master it will undoubtedly become the envy of their peers. Don't miss your chance to stay ahead of the curve. Now is the time to invest in your future and learn the secrets to YouTube success. Click the link in the description to get started. EL stock is indeed one of recent history's biggest bloopers that can't be ignored. These 3 analysts have completely ignored the fundamentals, and as the stock has hammered its investors, they simply stood on the sidelines, cheering and giving ridiculously overpriced bids or price targets. These analysts didn't even bother to play the usual game of chase with the stock price, which normally we would give an award for, but unfortunately for them, they have been completely wrong on their calls. Ming Sun of Bank of America Merrill Lynch is being charged with gross incompetence and first-degree negligence. As you can see on the chart, Ming began his coverage in early 2021 and has been consistently overbidding his price target and cheering unsuspecting investors to buy this company. Li Auto has had a very volatile history, and for anyone to just sit back and cheer investors to buy when the company clearly has issues going on is not only incompetent but completely negligent, guilty, and sentenced to a life of unpaid manual number crunching at your nearest investment bank. Jeff Chung of Citi is being charged with first-degree capital carnage because, as you can see from the chart, he clearly destroyed the wealth of anyone who dared listen to his bogus calls. Wow, this chart is bad. He literally overbid by ridiculous margins the entire way, except for right before the bull run when he decided to lower his bid, only to raise it again after the peak when all the money had been made. Let's have a moment of silence for all of his victims and all whose net worths have fallen because of this massacre. So we don't need any more evidence on this one. The chart speaks loud and clear, and he is clearly insane as he currently has a neutral buy call with a 54 price target as the stock sits in the low 20s. Guilty as charged and sentenced to a lifetime of having to make actual trades off of his own bogus-ass calls. Tim Xiao of Morgan Stanley is being charged with gross incompetence. As you can see, Tim didn't hesitate to grab his pom-poms and begin cheering this company on. He had a few moments where he attempted to play chase with the stock price and make an argument off of the fundies, but he soon decided that that was too much work, and then took a look at Jeff's chart and decided that he could get away with clocking in random numbers. But little did he know, the incompetence investigators were on his trail. Guilty as charged with gross incompetence and attempting to cover up his laziness. Today's roast session was a bit briefer than normal because these analysts barely even attempted to make it look like they were doing their jobs. One look at the charts and you can just see the incompetence screaming loud. One thing we noted on this one, though, is that the analysts didn't seem to follow the normal analyst groupthink pattern that we have been exposing on this channel. Normally, analysts more or less conform to a certain pattern of incompetence, but these guys just did their own thing. Now, I'm not going to in any way promote analyst groupthink, but I'll say this. With the normal herd mentality of analysts and the knowledge of how neutral calls can often be equated to sell calls, a hidden side effect of another occurrence on Wall Street that we have been exposing, we can at least confidently say that if a group of analysts are calling neutral in a downtrend, it likely means sell. But with these guys, they are all over the place, and you can't even attempt to uncover any patterns within their behavior. Definitely a rare occurrence, and grossly negligent and incompetent on all of their behalves. The writing was and is clearly on the wall with the fundamentals of Li Auto. Li Auto, a prominent player in the electric vehicle market, initially captured investor excitement with its innovative approach and ambitious growth plans. The company was celebrated for its advanced technology and potential to revolutionize the EV landscape in China. However, beneath the surface, significant challenges were brewing. As the market became increasingly competitive, Li Auto struggled to maintain its growth trajectory amid rising costs, supply chain disruptions, and regulatory hurdles. The company faced escalating raw material costs, which squeezed profit margins and put pressure on its pricing strategy. Instead of adapting to these changing market dynamics, Li Auto's management remained overly optimistic, leading to a disconnect between their projections and the reality on the ground. Analysts, perhaps blinded by the initial hype, failed to see the red flags, which included declining demand for certain models and increasing competition from both established automakers and new entrants. As financials began to show signs of distress, investors grew concerned about the sustainability of Li Auto's growth. Earnings reports revealed that operational margins had plummeted from over 18% pre-pandemic to below 10%, a stark indicator that expenses were outpacing revenue growth. This alarming trend triggered a downward spiral, with the stock price tumbling as investor confidence waned. Analysts, who once touted Li Auto as a must-have in any growth portfolio, now found themselves scrambling to justify their bullish positions as the company's fundamentals deteriorated. In the face of these developments, Li Auto's stock took a significant hit, reflecting the harsh reality of a company that had lost its way amidst an unforgiving market. As we delve deeper into this story, it's clear that understanding the underlying fundamentals and market conditions is crucial for making informed investment decisions. The lessons learned from Li Auto's tumultuous journey serve as a stark reminder of the importance of due diligence and the potential consequences of misplaced trust in overly optimistic projections. Today's lesson revolves around the importance of remaining cautious amid the hype that often surrounds high-growth stocks like Li Auto. In the world of investing, it's all too easy to get swept up in excitement, especially when analysts and media outlets are touting a company's potential. However, as Benjamin Graham famously advised, with his concept of Mr. Market, investors should treat market fluctuations as opportunities for rational analysis rather than emotional reactions. Graham's Mr. Market metaphor serves as a reminder that the market is inherently unpredictable and can be driven by irrational emotions. It's crucial for investors to recognize that hype can cloud judgment and lead to impulsive decisions. Instead of succumbing to the allure of sensational claims, take a step back and engage in thorough analysis. Assess the fundamentals of a company. Look at its financial health, competitive positioning, and market conditions. By detaching emotionally from the hype and employing logical reasoning, investors can arrive at rational decisions that align with their long-term goals. Remember, it's not just about what others say or how the stock is performing at the moment. It's about understanding the underlying value of an investment. Stay vigilant, do your due diligence, and ensure that your investment choices are grounded in solid analysis rather than the fleeting whims of market sentiment. Feel free to check out this video if you want to dive deeper on fundamental analysis and how to analyze financial statements.